morning, everyone. I think this is the first panel, at least on this stage. I hope everyone's having a fantastic consensus week. And thank you so much again to Hack Seasons for having us on this wonderful panel. Why don't we kick off with some introductions and then we'll get straight into the questions. To start off, my name is Nikita Sachdev. I'm the CEO and founder of Luna PR. Been in the space since 2017, started my crypto career with Huobi Exchange, now HTX in Singapore. And it's great to be here in Hong Kong, but currently in Dubai, where we're headquartered, offices in London and New York. Over to you guys.
Great. Yeah, my name is Kelvin Ko. I'm one of the co-founders of Spartan Group. We also started in 2017 and mostly focus on investing, both on the venture side as well as liquid markets. We have 4 funds at the moment. We also do quite a bit of advisory work, helping crypto projects to raise capital, do M&A, so on and so forth.
Cool. Hi, everyone. I'm Shaikh. I am one of the co-founders and partners of MFE, Maximum Frequency Ventures. We're an early-stage investment fund focused on really helping founders grow. We take an operator-led approach. I was formerly the co-founder and CEO of Aptos. Before that, I've worked on things like Libra, DM, and come from a background of financial institutions.
Hi, everyone. I'm John Fiorelli. I'm a partner at Kinetic. We started in 2016, one of the earlier funds in Hong Kong, investing in all types of amazing seed rounds and ICOs during that time. I came into the space about 15, 16, and with a focus on advisory. So we operate as a multifamily office. We do a lot of advisory with our portcos. Everything from product development, go-to-market strategy, fundraising, and the like. And we are based both in Hong Kong and Puerto Rico.
Hi, so my name's Nentor, the global CEO of Bitmart Exchange. We've been around for the past 7.5, now closer to 8 years. Mostly on the investment side, it's on balance sheet, mostly looking at synergistic acquisitions, but we also LP some liquid venture funds and also small, I guess, more strategic venture investments. Prior to Bitmart, I was a partner at Animoca's venture fund out in Hong Kong. Pleased to be here.
Awesome. It's really, really great to have all these incredible panelists. And Nentor, I have to blame you for my team being late to the event this morning. We heard you had a great party that ended maybe like 5 hours ago. But all right, great. Well, the market has matured so much since 2017 or 2015. You guys have been in the space for so long. And I think the highlight of 2025 was just so much institutional adoption from IPOs, from crypto companies doing IPOs to digital asset treasuries. Everything was shifting to being more institutional, being very US focused as well with Trump under Trump's administration. So to kick off, maybe I'd like to hear your point of view on where the capital is actually being deployed today. Anyone?
I mean, I can go first on this. We have 2 partners in the U.S., myself and Neil, who's right there on the crowd. We have 2 partners in Asia, Singapore, and in Hong Kong. And what we've seen is a massive shift towards energy moving back towards the U.S. And so founders that typically had to leave to, maybe live here, live in Singapore, live in Abu Dhabi or Dubai, are all sort of moving back on shore to the U.S. And so we're seeing founders, really not only kind of capture that wave, but also go out and build new products. I think the second thing to think about beyond geography in terms of like where capital is being deployed is different verticals. Finance sits at the heart of crypto, and so we continue to deploy capital in companies that are focused on disrupting or helping this industry evolve. I think we're way beyond just like the next stablecoin project or the next yield farming, the DeFi protocol. What we are starting to see though is a maturation that requires a depth of understanding of the financial industry. So BlackRock, where I used to work at before, just announced a partnership with Uniswap. I think a few hours ago while you were partying. And Franklin Templeton announced a partnership with Binance. We would have not have expected these types of partnerships 12 months ago. And so when we think about the types of founders that can sit at the intersection between these sort of large conglomerates in these two categories, you need a new type of founder. And so we're very excited to support these types of folks. Now, there are not that many of them, unfortunately, but these are the folks that I think a lot of investors are shifting their energy and their focus on. I don't know if y'all agree or.
Actually, yeah. I mean, to be fair, I think right now we've gone through a couple liquidity crises in the past few months. So I thought the title of this panel was fascinating. Which capital? But I think one question that we have, so from an institutional adoption standpoint, we are living in an increasingly kind of compressed rates environment where everyone's looking for yield with extreme amounts of money. At the same time, if you're trying to find yield, are people leveraging? Are people,
Right.
So where do you source yield? So right now we are looking at projects that are looking to provide yield, providing multiple methods in various forms of collateral, RWAs, equity, tokenized equity. Crypto is proving to be a good platform for settlements. And so I think that those opportunities are terrific. It's very competitive. And so as you're in an increasingly competitive environment, rates get compressed, fees get compressed. So figuring out who's going to be the winner and who's worth betting on, especially with their token, is a challenging prospect. To be fair, maybe I'll be mildly contrarian. I don't know if you guys have been going through all of the recent COPE on non-financial crypto use cases. Without picking a side, I'm someone who came into the space in 2017, obviously super excited about the financial use cases, but still thinking, and I don't know if I completely agree with Chris Dixon's recent missive about whether, and I don't think he's over-indexing on regulatory clarity, opening things up. But if in fact clarity does pass, and if in fact we can stay on shore, I do think that there are non-financial use cases, especially in AI space. Verifiable compute, I think, is a really important space. And so I am still bullish on non-financial use cases. I'm just looking for the ones who actually will construct a proper fee model and explain how that gets to the token. So that's kind of my thesis right now.
Can you give some examples of the non-financial use cases?
Yeah, I mean, obviously, it's easy to rag on gaming, partly because if you want to run an app and you want to be in an app store and you had crypto related, you were going to lose a big chunk of your market. And so gaming was tough for a long time. We all saw that. So does that environment ever change? Also, frankly, a lot of games just weren't or aren't fun. If it's not fun, I don't know how gaming works. I personally am not trying. I think GameFi is fascinating, but it's only on the back of gaming actually being fun. So there's that aspect. But personally, I'm an advisor to a company called Sovereign, which is the near DApp, but is deploying that capital into running GPU clusters in support of near AI's verifiable confidential compute stack. I think that's super interesting, and they basically launched the DAT with such patient capital that they can actually deploy that capital efficiently and earn fees. So I don't know, I know a lot of us have asked ourselves, when alt season, we've asked ourselves that a few times since Trump got elected. I just ask, when product market fit season, when fee season? And if you start to see those and it's provable towards a token, we're listening. As a family office, that's what we're looking for. Sorry, that was a very long answer.
No, that's fantastic. Nenter and I were actually with a company yesterday that seemed to be doing something in the metaverse, and we were just talking about how, this is such a 2021 type of project that we were reviewing. So, Nenter, where do you see the money flowing in today?
Yeah, and I think to John's point too on gaming, I'm a gamer myself, so obviously I'd love to see a lot of these succeed, but having looked at so many of these in my prior life, it really just, a lot of these were not optimized for fun. It was optimized for value extraction, like many projects in the last couple of years. So maybe I'll answer in two parts. Just looking at it from a secondary market perspective, since we're an exchange, I do see users over the last probably 7-8 months, really, those that would be trading altcoins are really flocking over to the prediction markets side. But the one thing about the prediction market side, the LTV for the average user is actually way shorter than if you're a perps trader, on average, I would say it's about 3 months for a typical prediction market user. So a lot of that money is getting sucked out and not coming back into the system. The other side of that is the hunt for yield. And this is where I think it's interesting because you have folks like Vita Labs, which we had an investment in them, and they just recently partnered with Kraken for the on-chain vaults, right? So I think something like that is very interesting. That's sort of where us as an exchange would be looking to deploy capital. Really, the projects that are solving for what we need, because every exchange will need an on-chain strategy. You see it across the board, and we're no different. So your stuff like Vita Labs or something that solves liquidity fragmentation. I think all of these areas are sort of at least where we would put our money.
Yeah, I can add a few comments as well, to what Nenta said, right? I think there's definitely very strong demand for yield and any strategy that's safe, right? So quant strategies that have an extensive track record, market neutral strategies, things like that, people want. So maybe that represents a maturation of the industry to a certain extent, but I think it also informs us of what kind of capital is also coming into the industry, because many of the family offices that we talk to don't like the sort of crazy volatility in the crypto space. So some of these strategies are easier for them to accept. And then we also have obviously a lot of these big L1 projects that raise significant sums of capital over the last couple of years and need to deploy that capital. So again, something like a market neutral strategy or yield strategy makes a lot more sense for them because they need to protect that capital and extend the runway with these strategies. And I think where things are, I guess, a little bit slower is on the venture side. If you look at venture activity, effectively activity peaked probably about a year and a half ago in terms of absolute sort of deal flow. And since then, we've been sort of on a steady trend down. And activity levels at the moment are probably more similar to what we saw in 2019 and early 2020. So very, very low activity. And that's not surprising, I think, partly because the quality of deal flow that we're seeing is not particularly high. We're also seeing some of that venture money going to other areas like AI and robotics, so there's definitely competition for capital. And last but not least, I think a lot of the last vintage of venture funds, the ones that raised in 2021, 22, really haven't delivered returns, right? So LPs are obviously being a little bit more scrutinizing and being more critical. I have no doubt debt will come back, but in order for that to come back, you need an altcoin, a better altcoin market. I mean, last year was brutal for all venture funds and all directional funds, right? So it's been a tough market to play in. It's encouraging, obviously, to see all the institutional money starting to come in. I think ETFs are helpful. I think DATs are interesting, but I think we got a bit too much of that, and I think we're sort of going through a phase right now where there's a bit of bloat there that I think will come back to haunt us in the coming months. And so we need to get through that as well. But long term, I'm hopeful that we see some of the long-only money coming into the space, right? Because if you look at the traditional assets, we all have long-only money that holds these assets through the cycle. And in crypto, we don't really have that. And so I think once we have that kind of capital, then we should see less volatility in the asset class.
Yeah, I think what you both said about yield is very important. I recall reading an article yesterday on the I guess civil war that's happening right now between the Clarity Act in Washington and basically how Brian Armstrong was first very supportive of it and then kind of pulled back, and how stable coins are yielding 3%, whereas US banks are yielding less than 1%. So they fear that money will get sucked out of the US traditional banking system and go into stable coins. Now, this has been all recent developments under Trump's administration, and Mo, you brought up as the US as a big geographical focus, new trend, and not trend, but rather a shift on where the capital is being deployed. What happens in the next election if the parties change? Do companies move outside, out of the U.S., where does capital flow from there, and what kind of risks does that display?
That's one of the hardest questions that someone can ask. The next presidential election. It is a valid point because structurally, obviously, U.S. democracy every 4 years there is potential change. We'll see something. Well, we're seeing the slowdown in clarity as a function of the democratic debate. I wouldn't call it a civil war. And I do think that very fortunately, crypto has been able to make a claim. The fact that Brian Armstrong is on Capitol Hill, Chris Dixon, myself, and many others spent time there. I think we're going to continue to have a voice at the table. I think that voice, was able to have, pretty significant influence in moving, the Genius Bill forward. I think clarity will get done this year, and so hopefully it doesn't, trickle into the next election cycle. But then I think you're raising a really good point where, if the next, the next presidential candidate ends up having an anti-crypto stance, I think there could be changes. However, again, I'm optimistic that people are starting to see the good in crypto, specifically around some of the things that we had talked about. I'm very, very optimistic that it does take technology 25 to 30 years to see new consumer use cases. And while finance has obviously benefited immensely, I think we're now kind of at the cusp of this next wave. And so as things like gaming, IP, AI, and other places have intersections with crypto, some greater than others, I think the next presidential cycle will hopefully be able to have those anecdotes and data points to continue to support crypto. And I would just say, having spent time with U.S. senators on the Democratic side and Republican side, they do agree with that. They do see those use cases, and I think that's a function and a positive thing of our industry that has matured over time. So I'm optimistic in that sense.
Yeah, we've seen we've seen so many different types of categories in crypto come in, get funded from, as I mentioned, the metaverse or NFTs or GameFi. Which category do you see being the one to stay, the sustainable one? I think even last year there was a big focus on DePIN. This year we're talking a lot about RWAs and stablecoins. So what is a trend and what is actually here to stay?
I mean, I personally am super excited about agentic, and I'm more excited and trying to be patient/impatient about safety around agentic. I think what we're seeing with OpenClaw and seeing what people are willing to do and what permissions they're willing to give to their agents is fascinating. And it just means that there's an appetite to be able to, in some ways, automate, but to benefit by not even having to think about a lot of aspects, whether it's payments, yield optimizations. I mean, frankly, I think we're all going to run after the tech and let it kind of push us. And I'd love to see more safety guardrails around that so that we don't have not even so much systemic risk, but I'd hate to see people lose significant funds as a result of not having enough infrastructure and tooling. So I think that's an area that could be really powerful.
For me, I sort of think about the retail distribution side and what retail can actually benefit from. The RWA tokenization trend, I think that will continue just because there's no shortage of assets to be tokenized. Whether or not it provides, additional incremental value and whether or not there's enough demand, I think that's, that can differ. Obviously, I think regulations have a very large part to do with it, whether or not there's sufficient liquidity or it's fragmented the way it is today. But I do believe the areas that are much more interesting would be the esoteric assets or the sort of private assets where individuals don't have access to today. So in obviously tokenized equities, right, could make sense for an individual in an underdeveloped market versus it doesn't add much incremental value if you're in a developed region. But let's say having access to private SpaceX stock, I think that could tokenized. That could be very interesting because that's not something everyone can have access to. So I do believe the tokenization trend is sort of something where we see continue to play out. I mean, when you just look at exchange volumes, I think just a week and a half ago, you saw the perps volume on Hyperliquid. It was on the commodity side that really dominated that volume. And I do think that the industry has matured where the underlying users sort of want different options, right? They're starting to be educated about the different asset classes. They're becoming more financially literate, and as such, distribution platforms like ours need, and your BitGets, your Binances of the world, everyone's doing the same thing. They see that trend, and that's sort of where you have to provide that optionality for users. So to me, it's very clear that the RWA trend will continue.
And just on that note, Nenter, just to touch base on that, with the equities, real estate, they make sense. But do all assets need to be tokenized?
Well, again, I think from the perspective of the issuer, it's why not, right? If you can get it into the hands of a different subset of users, why not? I think anyone that's capturing value from this trend, you're either originating, distributing, or servicing these assets. But again, it comes down to the incremental value it provides. For instance, I just had a conversation with a buddy of mine on the tokenization side just a couple of minutes before the panel, and we're talking about sort of on the institutional side, for example, what's the value of some of these, being able for these institutions that are crypto native, being able to trade on chain. Can you utilize that as collateral, etc.? That market is very small today, where we stand. But 5 years from now, it can certainly increase, pretty sizably. So I think maybe 3 to 5 years, but today it's still, quite small.
Yeah.
Yeah, I agree with what Nenter just said, because I had a conversation earlier this week as well with another tokenization platform, and they were going to bring some of PIMCO's products on chain, right? And I was asking them, so who's the end user you're targeting, right? Who's buying these things? And I initially would have thought that it would be family offices, and maybe some TradFi institutions. But he said actually the biggest end users who will consume that product are actually the foundations. And going back to the point that I brought up earlier about some of these foundations wanting to diversify their treasury away from their own tokens, away from just treasuries to other higher yielding strategies, but which have more predictable returns. So I thought that was quite interesting and sort of validates what Nenter was saying. But so other than that, I would say, I'm glad you actually asked this question, because you hear so much on Twitter, right, about, oh, we've been here for 7 years or 10 years, whatever it is, and nothing's been built, and nobody wants to use crypto. If you're on Twitter, I mean, it's depressing today, right? But I mean, if you've been in the industry long enough and you've been around and you look at what we have today, I actually think we've made progress, right? Because I mean, stablecoins are now going mainstream, which is big. We have RWA tokenization, which started back in 2017, and finally it's here, right? And we have prediction markets, which I would say is kind of like Web3 as well, right? So those are big use cases. DeFi is definitely now going mainstream as well, and if we can bring the likes of BlackRock, Franklin Templeton, and others in, then that accelerates the growth. And so all these use cases take time, right? But as John pointed out earlier, we need to have the right products. The products need to work, and they need to be what people want, right? And so in some other cases, we're still very early, like in gaming, for instance, and all good games. I agree with you. I've tried every one of them. And then AI will come at some point. So these use cases will come, but the products need to be good enough, right, to compete.
But Kelvin, what about the users? Where are the people that are actually not the builders, but the people that will actually use these products, will actually buy into these fractional assets? 2017, yes, tokenization was built, and I'm just playing devil's advocate because I'm the moderator and it's my job. But 2017, maybe you're referring to the St. Regis Aspen. That was one of the first tokenized, use cases. And back then we used to call it security tokens, right? Now it's RWAs. And the reason why it never took off was because there were no users. No one really bought into it. Are there users today? And you just said that the users, the end users are the foundations.
Yeah.
We're moving very institutional, but crypto was built in the essence of retail peer-to-peer. So are we moving in the right direction?
Yeah, so I would say a couple of things. One is, if you go back to, again, 2017, right? Firstly, the products weren't really what people were looking for, right? People, in many cases, I would say the products that we saw were products that investors in the traditional world didn't want, right? And they thought they could sell it to, by tokenizing it, right? So I think quality of products is an issue, right? And this time around, obviously, a lot of products we're talking about, these are all TradFi products that have long track records, and they're products that people want, number one. Number two, I think back in 2017, 2018, you remember there were a bunch of, I guess, call them securities tokens exchanges that were trying to set up, right? But eventually none of them succeeded because there were no users. And then because there were no users, there was no liquidity. And if there's no liquidity, who would want the product, right? So all of these things need to come together. And I think we're starting to see that come together because the big players are starting to get involved.
Yeah, I mean, so I in 2017, I built a security token platform called Meridio to tokenize real estate. We were actually ahead of the St. Regis Aspen, but it was a smaller asset. It was a multifamily property in Brooklyn, actually. It was a Reg A registered Reg D offering. And the reason that we wanted to do that is what actually Nanter was saying. Typically, folks don't get an opportunity to invest a small slice into a real estate property that they might be living in or renting in. This created that access. Unfortunately, what we learned is not that many people still are interested in it. And that was, and by the way, to your point of like how crappy the user experience was back then, like we were talking about DAI as like the primary stable coin. If anyone in the audience remembers that, you had to custody tokens through like MetaMask at the point, and like which institutional investor wants to do that onboarding flow? Nobody. And so we learned those painful lessons as builders. Today, however, the world looks very different. The onboarding flow is far more seamless. There's qualified custodians. There are clear rules and forms of how to do that. What we've also learned is still like, does retail really want to own a small slice of like property in Brooklyn? Maybe, maybe not. They're probably more excited about secondaries in Tesla or in SpaceX or something else. But even then, like, are you really having like a marginal difference? I don't know. Is it like incrementalism versus something else? It's hard to tell right now. What is very clear though is the other point I think this group has brought up. The primary use cases for tokenization is actually for financial institutions to reduce costs and the opacity within financial products. And it's exactly where the entire world is moving. The second reason is if you don't move there, you will not be part of the future financial system. So if you want to do things like securities lending or add leverage and you are not a tokenized asset, guess what? You're going to have an inefficient capital, formation relative to your company that does have, or your venue or your country that does support all of this throughout the stack. And so if you're not tokenizing financial products, you're wrong. I'll just like go out and say it. And so I fully agree. I think we should expect to see more of that. I do think as investors, we're probably trying to figure out like what are the investable ideas that help get there. Like I don't want to see another tokenization platform. Like I'm tired of that. I'm sure all of us are. But this is where interesting things like how do you do better portfolio construction with like risk management through AI could be an interesting idea. And so like again, we haven't seen mature founders yet come into like provide these ideas yet, but I'm optimistic that we will. So,
I violently agree with everything that's being said, so I'm going to try and add something to this. When we were in 17, I'll be honest with you, I didn't see a lot of product. As a product guy myself, I saw some white papers, ideas on napkins. We had a lot of the Larry ones come and visit us in Hong Kong at that time, raising their first rounds. And as a product guy myself, I was searching for something where maybe not mom and dad, but brother and sister would feel comfortable onboarding. So I think we are leaps and bounds progress has been made, and every institutional asset manager wants custody, they want security, they want essentially regulatory clarity with KYC, KYB. We have that, right? So, okay, great. So I know how my assets are mingling and interacting with the rest of the financial ecosystem. We've got that now. That's awesome. I think a few gaps that I think need to be addressed. One is, as we continue to work on public chains, we need more smart contract security. I don't think we're going to really tolerate billions of dollars of annual losses, especially when it hits retail. We have lived a long time, many years, where we just kind of accept that as a cost of doing business. What? So let's stop that nonsense. The way we do that is with real-time monitoring, fraud detection at the custodial level. We need that to be kind of a matter of course, so that mom and dad feel comfortable coming in the same way they feel with their banking.
It's an opportunity for the banks.
From your lips to God's ears. So, I think it's super important that we shore that up as fast as possible and make that a standard and expectation and a worthy cost. Frankly, we're still losing ridiculous amounts of money in January, and we still haven't figured this out. So for me, that's a gap that needs to be addressed above and beyond what everyone has said here.
And then, guys, what are your thoughts on valuations? When you're personally assessing companies, what are you looking at? Are you looking at valuation? Are you looking at fundamentals? What kind of metrics are important to you? And on valuations, how are a lot of these crypto companies coming up with such absurd valuations? Yesterday, we were sitting with a company, Nenter,
Right.
0 revenue, $12 million valuation. Why? How?
Only 12?
I mean, yeah, that's low for crypto. But
Right now.
What company is that?
I'm not going to say, but it was a metaverse company, no users, no revenue, not even full finished tech.
It was, I don't want to reveal too much about that company,
Yeah.
but it was certainly not investable in my view. But it was interesting. I had a lunch with several VCs that were in town 2 days ago, and we were just talking about I was just trying to understand better what they were looking at the growth stage and the early stage investing side. And I was pretty surprised. Like Kelvin, we were talking about it earlier. I was shocked that it was still 30 to 50 million was sort of the average range for these early stage venture investment. Because I would have thought, given sort of the the current landscape and the difficulties of raising capital, that it would have been much more compressed. And I think for us, because when we look at funding potential funds, whether or not liquid funds, ARB funds, or even early stage venture funds, we tend to want to look at sort of what sort of deals they're looking at as well. And we've spoken to many many actually that some raised successfully in this market despite despite everything else. But I really think from a valuation perspective, a lot of it is determined by supply and demand at the end of the day too. If it's a hot deal, it's nothing dissimilar to what we've seen in a bull market, where if there's demand, things are just going to get priced up, versus if the founder is desperate enough and they will lower that valuation to get that first check. So I don't think that's too different. So it's really just a function of the supply and the demand. And unfortunately, I think from what I've been hearing, most of the good deal flow is still in the US, SF, New York. And that's why a lot of these Asia-based funds have they have people on the ground in the US, sourcing deal flow, making connections with different sort of ecosystems and such. And, I don't, for the time being, I don't see too much excitement for sort of the deal flow that's in other parts of the world.
I think these are excellent points. Being in the Bay Area, New York, we see a lot of these types of founders. They all have the premium that you just talked about. I'll leave it at that. But luckily, we have two of our general partners, as I mentioned, one in Singapore, one in Hong Kong, and they've we've been very fortunate to meet founders here that have, maybe moved back from the U.S. for various reasons to like Shanghai or to Hong Kong or to Singapore, and they have had 7 to 10 years of like product training at like the largest organizations. When they come back home, they realize, okay, I have an amazing comparative advantage compared to everyone here. However, I may not be able to access the investors that I was able to, or the investors here in Asia don't understand me. So now these founders are having like an identity crisis, but they have amazing skills. And so we love these types of founders. We end up not having to pay a premium for these types of founders. I'm happy to share them. And we really see this as like a massive trend that we think will continue to perpetuate over the next 5 years, maybe even longer than that. And so I am like very optimistic for these types of founders in like the eastern part of the world, where we can kind of bridge them to the West. They have a very Western style of doing things. They're not afraid to fail or like go home and talk about failures at like the dinner table, right? Because it's not taboo. And so I am like very bullish on like that Eastern founder, and we've been fortunate to find several of them that we've invested in over the last 12 months or so.
I'd like to echo that sentiment. A couple observations. One, VC always lags, right? So it takes a while for founders to realize what market they're actually in, and they have to talk to another VC to understand that. It seems like just like Bitcoin has a 4-year cycle, it feels like sensible valuations for venture also has a 4-year cycle. I mean, we saw this in 19, we saw this in 23, and well, we're a year early, but it feels like we're kind of experiencing it again. I think I like your observation very much about founders who maybe are getting out of the echo chamber. They're also working with talent that's not necessarily full premium, where everybody's in New York or everybody's in the Bay Area.
No free lunches.
Yeah, some of our best performing, in spite of the market, some of our best performing are ones who have diversified teams. Yep. They're grinders. They're not. They don't celebrate when they close a round. It's part of the.
Keeps going.
Now the work has really begun. The other thing too I'd like to throw in there is that I think there's also been a change over the course of those two, like 19 and 23, where you're being asked to invest in a SAFT. SAFT means no accountability, period. So you go into these deals, then you find out, terms have changed.
Yeah.
Okay. The past 2 years, I guess I've been nominated by my family office and other investors that we work with to negotiate settlements with founders, to get to constructive resolutions where things get tough for the founders and they don't want to keep their commitments. Things have changed now where you're investing in Save Plus token, and some founders feel that because you're getting exposure to the equity in the labs entity, and you're also getting exposure potentially to a token that has an earlier liquidity, they can demand a premium. In some cases, that's not actually a bad argument. In some cases, it's not valid. So I think each of those kind of trends, as we've changed over the last 4 years, is kind of why we're experiencing some of this disjoint.
All of you have talked about the founders quite a bit in this, in this particular topic, and I guess I've noticed a lot of investors put a lot of emphasis on the founders than the product. Sometimes more so in the founders than the products. And I believe, if I remember correctly, all of you guys offer advisory and you come in strategically into a lot of projects. How important is it, and how do you nurture the founders to succeed? Like, what kind of tips and advice do you usually, guidance do you give them?
I was fortunate enough to study psychology in undergrad, so it ends up we end up being called like the founders therapists. But I think the reason founders feel comfortable coming to us is because having built Aptos, having built things like Meridio, and been a builder, product-minded, business-oriented, I think founders very quickly. I mean, we can assess founders very quickly as a function of that because we all speak the same language. You can make very quick decisions, but we also have a sense of what's going wrong, and like founders tend to like always tell us like the rosy story of like, oh, these are all our things that are going great at the end of the month. Well, usually like there's a lot that's going wrong, and so we try to like make it a safe space to really let that founder open up. and find that right problem that is required to be that needs to be solved in that month. And so, that only happens. That's not really a scalable solution, unfortunately. So, and you're absolutely right. Like, all these companies are founder-led. If the founder is not there, we see what happens to token price. We see what happens to the company's vision. And so, the founder's job is to maintain that culture in the organization, be able to traverse through, the various cycles that we've all kind of been through, and that takes a lot. Being a founder, personally, I can say, is a very lonely sport. It requires massive amount of sacrifice, and there's a lot of conflicting guidance that you're getting along the way. And so, I think it's absolutely eminent. I mean, it's absolutely important that we provide the right advice, and it's not stale advice from like building a product 25 years ago. It's like, how do you build? What went wrong the last 5 years, and how do you think about the next 5 years?
Yeah, I mean, you're preaching to the choir. Like, I run a PR agency, and executive positioning is so important. For me, I tell that to all my founders. Kelvin, not just focusing on the founders, but also the projects. And sorry if I'm deviating the question from where the money goes in crypto, but I'm sure there's a lot of founders here that want to know advice from investors like you. And I'm pretty sure we got a little bit of extra time in here. So, Kelvin, how do you guide people and projects today?
Well, I think there are different types of founders, right? And different founders have different needs. We have, in some cases, seen very strong founders, rock stars, absolute rock stars. We write them a check, and they go and they build, and they don't ever need any help, and they are successful, right? Obviously, very few of those types of founders, right? We wish we had more of those. And then we see founders that need help, right? Especially if they're first-time founders. Sometimes, and even if a founder has been through several cycles, they've founded multiple companies, but it's the first time in Web3, it's also a totally different experience, right? So we give a lot of advice when it comes to things like tokenomics, for instance. I think a lot of newer founders that come into the space don't really understand that, don't have networks with market makers, exchanges, and so on and so forth. So they need a lot of help from that perspective. They need a lot of help with fundraising, introductions to other funds that we work with, and so on and so forth. And then they need, most of all, partnerships, right? And because we have been investing in the space for the last 7-8 years, we have networks both from our investment side and advisory side that span across 300-400 crypto projects. And so helping the founder to make a connection to a more established project so that they could sort of integrate the product or their services to those projects can give them a big lift. So those are some of the things that we do. And then, of course, I mentioned that we have an advisory arm as well. So to the extent that some of these projects end up being successful and they want to raise a Series A, Series B, where they need to tap 30 million, 50 million, 100 million, that's where our advisory team can come in and help them raise those much larger sums of money so they don't have to spend time raising money. They can focus on building the team and the product.
John, what about you?
I actually spend about 80% of my time portfolio support and advising. And the reason why, and it's interesting you say this, I think a lot of funds, they're trying to go through a lot of deals. There's an efficiency factor and a time factor. Not everybody has an advisory arm, and for funds who are very good at it, it's really important. As a family office, I am the advisory arm, and the reason that we operate this way is because the role I'm typically taking is an extension of the founding team. And so their problems are my problems. And I think it's really important to want to lean into those problems. I think we are the sum of the problems we solve. And if you are an advisor and an investor, whether it's supporting on a fundraise, making sure that there's focus, and frankly, just finding the highest leverage advice, highest leverage introduction, to the extent where fundraising is actually an exercise in business development more than, because honestly, there's plenty of money.
Yep.
And so that value is really tremendous, and I think it's, for us, as part of our culture, we really love getting in the trenches, but making sure that we're not overstepping, we let them solve their own problems, and where we see either gaps in the team, we help drive placement. We don't advertise this, but we spend an enormous amount of time helping place executive team.
Yeah.
It's probably the highest leverage, valuable thing that you can do. Especially, like you can coach people, but as they say in movie making, directing is actually, 2/3 casting, right? So that's kind of how we work as a small team.
And I think since we have a bit more time, linking that with the topic about valuation, which we discussed earlier, I think a lot of founders as well don't really necessarily know how to structure a fundraise, for instance, right? I had a conversation a few months back with a friend, somebody that I'd known for over a decade, who's building in DeFi, and he raised his first round 2 years ago, 75 million, without a product, with relationships, basically. And since then, he's launched a stablecoin, he's got $400 million of TVL, and he wants to raise a follow-on round before he goes public, right? And so he comes to me and says, hey, we're mature now, like you guys to come in, and I said, what's the valuation? 150 million. So I said, I'll talk to my team, but most likely we're not gonna be able to do it. And he says, why? I said, well, just so you understand how it works, right? So if I'm investing at 150 million, my target is to get a 10x out of the 10x return, right? Because I'm gonna have winners, I'm gonna have losers, and probably more losers than winners. So if I can get 10x, then maybe I can hit a 3 to 4x return on the fund, right? And so in order to hit 10x on 150, your valuation is going to be at 1.5 billion by the time I exit, right? For your valuation to be at 1.5 billion, the TVL metric you need to hit is 15 billion. You're at 400 million. If you're confident that you can hit 15 billion in the next 3 years, we can have a discussion. And he wasn't confident. So the conversation ended there, right? So I think it's a sobering sort of discussion, to sort of frame that so that the founder understands what he's looking for. And since that conversation, token's been listed, it's trading at 35 million today, right? So the first round investors lost money, and the second round investors lost their money, right? And the market's absolutely brutal. And valuations have steadily been coming down. But they started at levels that didn't make sense, right? There was a point in time when every infrastructure project was raising at over $1 billion, right? We invested in Layer 0 at, I think it was 50 million, and the second round was $1 billion. We invested at Celestia at 50 million, second round was $1 billion. So everything just went crazy, and part of that was obviously the cycle, but part of it was just the abundant amount of venture capital that existed, right? They just pumped up valuations beyond levels that made any sense. And so all of that is now playing out in the public markets, and I think we're in for some more pain over the next few months before things get better.
Yeah, and I think to Kelvin's point, even when you look at it from the secondary side, listing projects, ultimately there is no asymmetrical upside left for secondary markets once it's listed. It all exists in the primary market for the VCs if there are and if they actually found the right project. So that's why even on the listing side, I think most exchanges would agree that when you're launching at a 2 to 3 billion, it's there's only one way, one direction it's going to move. And look, a lot of these projects, I think for the most part, a lot of venture capital funds have invested, for one reason or another. It still remains to be seen whether or not longer term, how they'll do. But I think for the time being, it's certainly not too hopeful. And that's why even for us, when we're looking at listing projects, it's again, it comes down to a supply and demand issue. Do your users actually care or want to trade this in the secondary? And right now, the answer is there's not that much appetite.
Yeah, that was really insightful. It really sometimes seems like it's basic math, but crypto can get your head in the clouds. So it's good to have these sobering moments, like a good old bear market, if we are in a bear market, I don't know, but a market like this, and gives you a bit of a reality check. I hope it was insightful for everybody here. Thank you so much to our panelists, and we'll be around.